Starting, all attendees are in listen-only mode.
Hello, and welcome to another great webinar from cpaacademy.org. My name is Jasmine. It's my pleasure to moderate today's course. This is Strategic Cash Balance Plans for Small Business Owners. I've got your presenter here, Isaac from Divergent Wealth. He's going to be bringing this topic to you today. But before we turn things over, I just want to make sure everything's working for our audience. So if you haven't already, head on over to that control panel, pop open the questions tab, and type me a quick message there to let me know that you can hear my voice and see the title slide. You should also be seeing our webcams for the time being. Also, feel free to let me know where in the world you are tuning in from today. Whoa, I'm checking that out now. I'm seeing Karen in Mississippi. Hello, David in Nevada. Hi, Gary in San Francisco Bay Area. We've got Colorado Springs, Japan. Thanks so much for tuning in, and thanks so much for confirming that everything is working. If at any point you do run into technical trouble, leave me a note right there, and I will get around to you as quickly as I can and get you back on track with the presentation. Also, as you come up with questions or comments about the presentation, you can leave those right there for Isaac. We'll do our best to address all questions during the webinar. If not, I'll be sure to share those details with him after we shut down everything today. Now, you may have a few questions about credit. This webinar qualifies for 1 CPE credit. To earn that credit, I'll need you to do 2 things. Stay logged in with us for at least 50 minutes total and respond to our polling questions. We will announce and launch a total of 4 polls. And for the best experience, I encourage you to answer as many polls as you can and as quickly as possible. Now, we are recording today's session, and that archive, as well as your CPE credit, will be in your CPA Academy account a little bit later today. Also, for now, just know that we are going to be sharing handouts as well. You can find those right now in the control panel's handouts tab and follow along with the presentation or refer to them in the future. And with that, I'm going to go ahead and turn things over now. Isaac, our attendees are ready, and the floor is all yours.
Hello, I'm excited to chat with you today on probably one of my favorite topics out there. My name is Rizik. I'm a CPA certified financial planner professional. And when it comes to cash balance plans, this can be an awesome opportunity. Now, I'll tell you, it's not for everyone. And we'll dive into what kind of a perfect situation would look like for a potential client of yours or somebody that you may work with, maybe for you personally. We'll talk about small business owners, different retirement planning strategies that will make sense for you. And it'll be an awesome opportunity for you to ask questions. So feel free to put those in the question section, and we'll get to a few of those today. Let's jump right in. Okay, first of all, education, not advice. You kind of know the drill there. Okay, so I'll tell you, I love fishing. I'll tell you just briefly about me. I may make a few fishing references. I'm out of Utah. I work with clients all over the country, but I love to catch fish. So connect with me on LinkedIn, and I'll be your biggest fly fishing hype person. Here's some things we're going to chat through. We're going to identify a few different retirement planning strategies for you or for small business owners that you work with. We're going to understand the differences between a defined contribution plan and a defined benefit plan. We're also going to look at some opportunities for cash balance plans in connection with other qualified retirement accounts like a 401k or a profit sharing plan, for example. And then at the end, we'll evaluate whether someone's an ideal candidate for a cash balance plan or not. I'm excited. Okay, I think it's helpful to just kind of jump in and so you can see an illustration of what this looks like. Now, ultimately, an actuary determines contribution ranges, funding limits, and other cash balance plan features. And it really depends on your wages and your age. Those are the 2 biggest indicators for how much money can be put into a cash balance plan. And so let's kind of jump in and let me paint the picture. Before I do that, let's just take a step back and help you to understand what a cash balance plan is. It's a retirement plan that is a hybrid of both a defined benefit and a defined contribution plan. Now, when I say defined benefit, for most people, they're immediately going to think of a pension, where you get a specific defined amount when you retire. Oftentimes that comes in the form of a monthly annuity or a monthly check. On the other side, typically when we think of defined contribution plans, this is going to be something like a simple IRA, a SEP IRA, 401k, or 403b, something like that, to give you an idea. Okay, so now let's paint the picture here. A small business owner, husband and wife, they're the only employees in their business. They're in their 50s, and they have a decent amount of cash flow coming into the business. Now, typically when we do these, it's going to be for an S corp. It doesn't necessarily have to be. It can be for a sole proprietorship or for a corporation. There's no substantial qualified retirement assets. And really, this framework that I'm going to show you is for a client that I just worked with a couple of months ago. And so it's a real life situation here. They really just put all their money into real estate and back into their business. And so as they're applying that money into the business, they really didn't focus on saving in a health savings account or IRA, those kind of things, 401k, for example. And so now we're kind of playing catch up. They have a significant amount of cash flow, and their number one goal is deductions. They want to defer as much income as they can today down the road into the future, because the plan is for this individual, they're going to sell the business in somewhere between 5 to 10 years and then go cruise and travel the world and do what retired people do. In fact, in my experience as a financial planner, most people in retirement, they don't actually like sip pina coladas and golf every day. Rather, they kind of pivot and maybe work part-time or do some consulting. But for this example, we're just going to plan on them kind of selling the business in about 2 years or so. Awesome. Let's continue on. Okay, so here's the illustration. There's some numbers here, and I'll show you this again at the end so you can have a really kind of good understanding of what's going on and why a cash balance plan is so powerful. And before we jump into the numbers, let me say this. With a traditional 401k, if we look over here on the right-hand side, and this is showing 2022's numbers, so for 2023, it's $2,000 more. But $20,500 is how much you could toss into a 401k. And then if you're over a certain age, you can get it a little bit extra. For this couple, they didn't want to do the catch up for one of the spouses, just one, based on cash flow and limitations. So anyway, we were able to get in about $41,000 plus another $6,500 into the 401k. And I'll tell you, with a 401k and a cash balance plan, we really use them together. Probably 90% of the time when we use a cash balance plan, we're going to link it up with a 401k or profit sharing plan to really jam pack, front load those retirement planning contributions. Okay, so now that we've got the 401k, let's come back to the beginning. They're age 51 and 56. We've got some planned compensation of $137,000 and $24,000. That is just another way of saying W-2, right? So in this situation, if we have they're taxed as an S corp, then we're gonna make sure that we're having W-2 enough to take advantage of the 401k and the contributions. Now, of course, you want to balance, right, between FICA taxes and contributions to retirement plans. And so this is when it would make sense to work with a CPA or a financial advisor to really make sure we're kind of walking the sweet spot on whether or not we should just do you or you and a spouse, or if we want to pull in outside employees as well, which we'll get to discrimination in just a different kind of discrimination. We'll say ERISA discrimination. Okay, so we've got planned compensation of $137,000 for this individual, $24,000 for the spouse, and $161,000 total. With a cash balance plan, we're able to get in almost $200,000 in the first year that we open this cash balance plan, and about $50,000 for the spouse. That's an enormous amount. Okay, so let's pause. How can we defer and get a tax deduction for that huge, enormous amount when their planned compensation is significantly less? It's because of their age in large measure. I'll tell you, for cash balance plans, it really makes sense for somebody who's in their 40s, 50s, and 60s is kind of that sweet spot. And the IRS actually allows us to kind of front load or dump in a big chunk into their retirement plan early on, kind of a catch up for previous years. We also added on a profit sharing feature, so we get a couple extra thousand here. So a total contribution in that $250,000 range. It's interesting to note over here, you can see contribution as a percentage of pay, and that's contribution to the retirement plan. And then we add the 401k to it. These are the totals, and we actually got 300,000. Now, this is very, very close to what I just did with a client a few months ago. And I thought it was interesting to show you, just to kind of maybe get your mouth wet, so to speak, just so you can kind of taste it of what the vision is with these cash balances. And I'll tell you, for this couple, it was just them. They didn't have any employees, and it really made sense for their situation. Okay, so we've got a question coming in. What do you mean by planned compensation? Planned compensation is going to be the W-2 wages that they receive. Now, if they don't file as an S corp, that's fine. If they're a sole proprietorship, we can still take advantage of this. It's just slightly different. Good question. Okay. So it's an enormous tax planning opportunity, right? We're talking 300,000 in tax deferrals in a single year. Now, for this client, they were in California, so not only do we get to save on the federal side, but also on the state side. So that can be a significant amount of savings. Now, eventually you're going to have to pay the taxes, right? Because you're going to have required minimum distributions later on in their 70s, and eventually that will be taxable. But for this couple, they're planning on leaving the state of California. So even another reason, nothing against California. I used to live there personally, but we all know California is one of the highest state income taxes in the country right now, and so it can be extremely advantageous. Okay, so this just kind of shows you an illustration of what a 10-year max funding schedule would look like. So this would be for a couple, and we're saying, again, with the cash balance plan, let's put in a lot of money now and over the course of years. And again, we're restricted. It's really based on the last couple years of your wages. Typically, we'll look back the last few years, and then we will anticipate a required benefit. Now, there are laws that restrict how much you can get in and anticipate to receive at your retirement age. Typically, it's going to be underneath $3 million, but essentially, we're able to put in a lot of money, especially and I'll give you the sweet spot here. This is kind of for somebody right in their mid-50s. We're doing a lot of catch-up, no other retirement plans. They're able to sock away an enormous amount of money over the next few years so that when they go to sell the business, they're going to have a significant amount in retirement savings. Okay, so let me just talk to you about some plan features. For normal retirement ages on these type of hybrid plans, again, this is a hybrid between a 401k, where you define the contribution. The IRS says, hey, you're only allowed to put X number of dollars in, and a pension plan, which you get a lot more flexibility with, and it's a combination of your age and your wages in most cases. You can create your own eligibility around these plans. There's a lot of variety. So for this one, we said, hey, you got to be age 21 and have at least 1 year of service to be eligible to participate in this plan. I'll tell you, we designed it this way just because it's husband and wife, and they don't have any other employees. But you really have some flexibility on this side. Now, when we connect it with a 401k, let me give you an example. Let's say we're working with a dentist office, and you've got a dentist and maybe 10 employees in the office. Those 10 employees oftentimes are going to be paid significantly less than that dentist. We can use a 401k to make sure we check the box on any discrimination laws so that we're clean, both with ERISA and the IRS. And so that we give them a certain amount, but we don't give them too much. And we really are able to kind of front load or catch up in this later on. So that being said, I don't want you to think this is set in stone. We've got some flexibility. We did a 3-year vesting, and then that just means, hey, you've got to stay with the company for 3 years in order for the benefit to be yours. Dual entry for the husband and wife, and then we've got some profit sharing contributions, just to give you an idea of the one that you just saw. Awesome. Okay, let's do a polling question. Jasmine, can you hit us off with the first one?
That would be my pleasure. I'll go ahead and get that first poll up on everyone's screen. You should see that taking place of where you were previously seeing the slides. And to respond to these polls, you're going to click the radio button that corresponds to your answer, and be sure to click submit to register your response. Leave each poll open for about a minute. Let us know here how familiar you are with defined benefit plans. That's poll number 1 of 4 up on your screen. Thank you all for voting in so quickly. And I'll go ahead and close this first poll down in 5, 4, 3, 2, and 1. I'll share those results briefly. You can see the majority went with somewhat familiar. And I'll go ahead and turn it back over to you.
Awesome. That's perfect. So many cash balance plans end with a rollover to an IRA, sometimes followed by Roth conversions. So let me explain to you how this often works. We will design a cash balance plan in connection with a 401k and maybe a profit sharing plan, put a ton of money into it for a couple of years, and then we'll dump it out either at their retirement, if they sell the business, or if there's some substantial reason. Now, you've got to have a few reasons to terminate these cash balance plans. And they're really, when you open one up, you're really kind of committing to something between 4 to 6 years of having the plan open. Of course, you can end it earlier if there's a good business reason to do so, but that's really kind of the time frame of most of these plans. And then we'll roll it over to an IRA. The biggest reason is with an IRA, you get an enormous amount of flexibility over how you invest it, your independence, whether it's for you or for an employee that leaves. The employee leaves a plan, we can roll that over to a 401k, or they can roll it over to an IRA or another employer-sponsored plan. But this gives an opportunity for that business owner, typically the one who's receiving a significant portion of the contributions to their cash balance plan, to be strategic around the timing of when they pay the tax. Now, I won't get political with you, but I'll tell you, at the end of 2025, we know that the Tax Cuts and Jobs Act will sunset, and a significant amount of tax legislation will revert back to Obama-era tax law. Now, the reason I said I won't get political with you, in my professional opinion, boy, in the next couple of years, I imagine Congress will have to do something around the debt ceiling, the increasing cost of capital that they're going to have to pay, around the debt that they have, and the different Federal Reserve rate hikes that we've had over the years. I don't have to tell you, I know that you know that already. But eventually we're going to have to pay for all the stimulus that we had over the last few years. And so it might be advantageous to consider Roth conversions right now. Now, this is me pausing from the cash balance plan and just kind of explaining what a Roth conversion is. Essentially, that's when we take pre-tax retirement money, we recognize a portion of it. We usually don't convert it all at once, but chunks, and we convert that into a Roth IRA. The nice part about that is there's no income limits, right? You can convert as much or as little as you want right now under current legislation. And so that might be advantageous for you if your client is going to retire or take a step back, or just their income is going to drop and they're going to work part-time. It might be strategic between whenever they retire and when their required minimum distributions take in the 70s. And again, that just changed with the Secure 2.0 Act. It used to be 70 and a half, then it went to 72, and now it's closer to 75 depending on your age. So again, something to think about with Roth conversions can be a powerful tax planning opportunity. And so typically we do Roth conversions after that we've sold the business or after the person's retired, but before those required distributions kick in. Okay, let's keep going. So here's some characteristics of an excellent cash balance plan candidate. They're going to have solid, consistent cash flow. This is not going to be a good plan design for a company that just started last year or the year before. Certainly probably not for like an up-and-coming company that doesn't have any profits and cash flow is unpredictable. For the client that I gave you an example for before, they're heavily involved in real estate and they have like a shipping business. It's pretty predictable. They can kind of understand what's going to happen in the future. And the reason it's so important to have consistent business expectations and cash flow is because when you open up a cash balance plan, you are really committing yourself to fund it. It's not like a 401k or profit sharing plan where you can be flexible and toss in 6% this year or 3% the next year. With a cash balance plan, you're really committing yourself to funding a certain amount. Now, with that being said, when you work with an actuary and a third-party administrator, that's going to be an organization that will help you to take care of the planning, the documents, making sure you're in compliance with ERISA and IRS. They're going to give you a range of which you can fund. And that range will fluctuate really depending on two things. It will depend on how many employees you have and what you're paying them, and the rate of return you get on the investments inside of the cash balance. We'll talk about that in just a moment. Next up, really it's ideally created for businesses with less than 20 employees. Now, you certainly can go bigger than that if you have more employees, but it's just a smaller headcount, really reduces costs and magnifies the return on the investment, right? Because with these cash balance plans, the costs are a little bit more than a 401k, simply a couple of $1,000 more, just to give you an idea. It's awesome to accelerate savings for retirement, and if you're looking for huge tax deductions. I know right now a lot of people are, especially business owners, are craving tax deductions. And the nice part about this is there's very few deductions that you can get as a business owner where that dollar is saved for you for retirement. It's not like you're paying a vendor or somebody else. You are literally deferring that tax right now, 100 or 200,000, and being strategic around when you pay it in the future. It's great if you're in a high tax bracket, of course, that goes without saying. Again, we use them in concert with the 401k. And typically, we do like a 3 to 4% contribution to employees. With 401ks, there's a lot we could dive into. Most often, we're going to use a plan that allows us to be within a safe harbor, meaning we've got the green light from ERISA and the IRS, and we don't have to worry about discrimination or testing requirements as much. It's really good if there's a large gap between the compensation of owners and employees. So let me give you another example. Let's say you're working with a CPA firm, and you're going to have the partners at the firm that are going to be making significant. Managers might be in the middle, and then at the bottom, you're going to have some staff with some back office support team. Typically, there's going to be an enormous difference between those partners of the firm and those that are at the lower end. And so if you have a firm with that kind of framework, boy, this can be an awesome opportunity. And typically 40s or older. Now, I got another client on the East Coast, and they're in their mid-30s. It's him and his spouse, and he is a nurse anesthetist. He created a cash balance plan, and he's able to sock away a healthy chunk into that retirement plan each year, but not nearly 300,000. It's much closer to kind of the $100,000 range or so. Okay, let's continue on. So knowing the basics. What is a qualified retirement plan? It's a plan or account with the blessing of the IRS. So essentially, you get some benefits. Not only special tax treatment, but bankruptcy and creditor protection. And so you get that the same with a 401k as you do with a tax plan. It can be significant for you. And we talked about the two types: defined benefit, which is like a pension plan, and a defined contribution, like a 401k or IRA. And again, cash balance plan is your right in the middle. Okay, let's do another poll. Jasmine, can you hook us up with the second one?
Absolutely. That second poll has just been launched. I see lots of our attendees are already answering that one quickly. You have about 60 seconds to let me know the definition of a 401k plan. You have 4 options to choose from. Go ahead and cast your vote now for poll number 2. I see that we have about 82% of our responses recorded. There's about 10 seconds remaining here. Be sure to go ahead and cast your votes. Don't forget to click that submit button to make sure your response registers for credit. And we're shutting down the second poll in 3, 2, 1. You can see the overwhelming majority answered defined contribution plan. Back to you.
Awesome. You're spot on. That's right. With the 401k plan or profit sharing plan, the IRS restricts how much you can put in. They've defined the contribution, and they've limited how much you can put in. With the defined benefit plan, on the other hand, much more fluidity and planning opportunities. Again, those are really dependent on your income and your needs. Let's talk about the other two options for just a minute. Roth IRA. Most of you probably know what that is. Awesome opportunity to take advantage of, especially if your income's below the threshold. Now, of course, we know the backdoor Roth. And I'll tell you, I don't know what CPA or tax preparer came up with the name backdoor Roth. It makes me smile every time I talk about it with a client. But with a backdoor Roth, essentially you make a non-deductible contribution to an IRA and then immediately convert it. Now, there's some issues with what we call a pro rata rule that you'll just want to be sure to navigate. Essentially, that's if you have deductible money inside of an IRA that has not yet been taxed. But we can work around that by rolling that over to potentially one of these retirement plans designed correctly. So something to think through. And we'll talk about the mega backdoor Roth in just a minute. Again, I'm not sure who's coming up with these names, and it makes me laugh every time I hear them. Okay, let's talk about these two plans again and some of the features. So defined contribution on the left. Again, I want you to think pension. On the right, think 401k, and cash balance plan has features of both. So who makes the contribution to a defined contribution plan? With a defined contribution, excuse me, I think I may have missaid that. Defined contribution, that is going to be 401k. That is going to be a pension. Okay, with that being said, contributions are made by an employee to a 401k. And of course, the employer can toss in a matching contribution if they desire. With a defined contribution plan like a 401k, the retirement benefits are variable, right? The employee puts the money into the 401k plan. The employee has their own separate individual account. And typically they pick from a lineup of different mutual funds that the plan sponsor, the employer, provides within the plan. Oftentimes it's like 10 or 15 different mutual funds that they can pick from. The admin costs for these types of 401k plans are significantly lower. The investment portfolio responsibility is on the employee. It's up to the employee to invest it, whether they decide to put it all in bonds or in a money market or in stocks, right? It's all on them. If it goes up or down, the employer doesn't bear any responsibility. Then, well, I should say limited, because they have to have a decent and fair options. They have a fiduciary responsibility to the plan. Typical contributions kind of in that $60,000 to $70,000 range right now, and those go up every year typically. Defined benefit plans, on the other hand, here on the right, contributions are made by the employer and only by the employer. The retirement benefits are guaranteed because it's going to be based on your age, and there's some formulas involved that you'll have to adopt when you participate and open up one of these defined benefit plans. And so it's going to be a function, and the employee is going to know, hey, if I stay with this company and my income goes on this trajectory, I can plan on receiving this amount. Now, oftentimes, this can be used as an annuity, right? So they're going to receive that monthly payment, but certainly you can have it as a joint and survivor annuity as opposed to just single life. That means, if you and your spouse, if one of you dies, the other one will still get paid out. Of course, that's usually lower. And then the third option, which is very, very common with cash balance plan, is just a lump sum rollover directly to an IRA. Admin costs with these defined benefit plans a little bit higher. The investment portfolio responsibility is on the employer. The employer's on the hook to make sure that the plan stays funded. And in fact, many cash balance plans have to pay premiums to the PBGC, the Pension Benefit Guaranty Corporation, to make sure that their plan is in compliance. And if something were to happen, the PBGC would then come in and kind of make things whole to some degree at least. So something to think about there. Similar to the FDIC, I know that's maybe on top of minds for some of you, but a little bit different here. We're talking about pension plans. And of course, the contributions are significantly greater. Again, when we combine cash balance plan with the 401k, like we saw in the previous example, we can actually exceed this $265,000. Okay. Cash balance plans are kind of in the middle after that. Perfect. Okay, with cash balance plans, again, these are going to be all deductible. With a 401k, you can have 2, potentially 3 different options to make contributions. Of course, pre-tax is most common. Then you've got Roth. tax-free. That's where you pay the taxes and you put the money in. And then the third is after-tax non-Roth. And after-tax non-Roth might make sense for your 401k if you're really trying to jam-pack it full of contributions. Now, when we combine a 401k with the cash balance plan, it may not make the most sense to have that feature, but if we're just going to look at a 401k on its own with an after-tax contribution and then immediate conversion to Roth, we're able to sock in roughly another $40,000 on top of that $20,000 or $22,000 or so that you can get into a 401k. That's what we call the mega backdoor Roth. It can be a powerful tax planning opportunity to sock away, somewhere between $60,000 and $70,000 into a Roth account. This is really common for high income earners, small business owners that are in their 20s, 30s, or 40s. We see it often. Okay, so when a cash balance plan terminates or a participant reaches retirement, we talked about the lump sum rollover. Typically, 401k is not the preferred route to roll a cash balance plan into because you are required to have to file a Form 5500 if the assets are over $250,000. Now, it's not a significant amount, and depending on your situation, but I'll just tell you, like I said before, typically we're rolling them to an IRA. We talked about the backdoor Roth within an IRA, and then mega backdoor Roth within the 401k. Here's something to think about, though. I'll tell you, with a 401k plan and with the cash balance plan, you do get the loan feature. Now, it typically doesn't make sense, and most small business owners with this amount of cash flow and income aren't anxious to get a $50,000 loan. And I should say it's 50% of your account, your invested account balance, or 50,000, whichever is lower. Most instances, we hit 50,000 pretty quick. And so you're able to take a loan from either a cash balance plan or your 401k. The minute you roll it over to an IRA, you don't get that. So that's something to think about. And again, depends on yours and your client's situation. Okay, we talked about the annuity as an option to another or a rollover to another qualified plan. Like I said before, oftentimes we're going to do a rollover to an IRA. If you terminate a plan and you've got other employees, typically they'll do a rollover to a 401k or another employer-sponsored plan. But of course, if you have long-term goals with this cash balance plan, you can offer the annuity option. An annuity potentially would look something like this: like participant reaches the age of 65, they've got $250,000 in their account balance, and then they start taking annuity for $1,500 a month. That just gives you an option, something that it might look like. Again, illustration, right? Okay, managing your cash balance plan, the details. So participants have an individual account, but it's not like a 401k. With a 401k, you get a statement and you're going to see your investments go up and down every quarter or every month. With a cash balance plan, your employees are going to see an expected, anticipated, kind of like an estimate of the amount that's within their account. And in fact, they really don't have like a personal individual account. When we have a cash balance plan, it's kind of like a pool of funds, but they're going to have an estimate tied to that amount. And it's on the employer to make sure that the investments in this pool are substantial enough and going to pay out whenever there's a rollover or that employee retires. Now, there's two types of credits that are made to a pension plan. The first is an interest credit. Essentially, this says, hey, employee number one, we've got an expected anticipated amount for you of $50,000, and that's going to grow, let's say 5% every year. You don't have to do anything, like we're just going to have that credit. And typically it's based on U.S. Treasuries. And so let's just say 5% for this example. In addition to the interest credit, you can kind of think like the investment growth. Again, there's a disconnect. We're going to have a pay credit as a second thing. The pay credit is based on your wages, right? So the more you make, the more the employer is going to be required to put into your account for your estimated retirement benefits. So like I said before, cash balance plans, they really got to be permanent when we set these up. Of course, you can terminate them in a common lifespan somewhere between 4 and 6 years. There's some vague language here from the IRS. And so typically we just kind of say a few years, but there's got to be a valid reason to in the plan. For example, well, there's a number of reasons, but let's say, for example, you sell the business, or you sell a portion of it, or you retire. There's a lot of options that we can have in this, and it really depends on the business. Okay, so how do you set one up? You're going to need a custodian. Oftentimes, I use Fidelity for me and my clients, but Schwab, Vanguard, you've heard of these names, low-cost options where you can set up a retirement account and you can actually invest within that account. Now, let me pause on this and let's talk about self-directing, because I know a few of you have asked about that. With a self-directing retirement account, you get a lot more flexibility than just kind of your typical stocks and bonds and money markets. You can actually invest in a piece of real estate. You can actually go buy a property. But there's a lot more restrictions, and there's some kind of rules you have to follow if you decide to go the self-directing route. I'll typically tell you for a cash balance plan, it doesn't often make the most sense. But for a 401k, if that's your sole focus, that could be a really good option for you. I typically, when I work with small business owners, especially those in real estate, you want to invest in what you understand and what you know. And so a self-directing account might make sense. But I'll tell you, for the large majority out there, we're going to be using something like a Fidelity and investing in a stock or bond portfolio. We'll use a third-party administrator that really just kind of helps, does a lot of the heavy lifting, the legwork and compliance and paperwork filings. And an actuary. An actuary is going to be required to sign off and make sure that the plan is in compliance with both ERISA and IRS law. Oftentimes the TPA, the third-party administrator, and the actuary are the same team or the same entity, and so that just really makes things nice. Okay, so how do you do a rollover? Again, we're going to have plan termination. Let's say, so you could still have the business functioning. You open up a cash balance plan, stock away a ton of money for 5 or 6 years. You have a qualifying reason to terminate the plan. Awesome. Now you can do the rollover. You still have the business open. Everything's still rocking and rolling with operations. And that's how you do it. Roll over to an IRA. And again, if you roll it over to a Roth IRA, which rarely would it ever make sense, but just to give you an example, you would have to recognize the tax on that whole conversion. The custodian, the TPA, would help determine the vested account balance. And yeah, let's do that. Okay. So I'll tell you, with a cash balance plan, they're more expensive than a 401k. The average cost to set up one is somewhere between $2,500 and $4,000. And then you have ongoing annual maintenance costs for the filings of $5,500, for the actuary to make sure you're in compliance. That's kind of where you're looking at, maybe in that $5,000 to $8,000 range, typically to set up, and then the ongoing fee. Now, if you hire a financial advisor or financial planner to manage the assets within the cash balance plan for you and for your employees, then there's some fees on that, like an assets and management fee, or maybe they charge an annual fee for you. Again, with the cash balance plan, we're talking about a significant amount of money. It can get really big, really, really quick. And oftentimes, we're investing that more conservatively. So let me give you an example. Let's say I'm working with a dentist, high income, and it's just him and maybe another partner, and they've got a few people below them. What we're going to do is, for that individual dentist, likely we'll invest their 401k or other investments more aggressively. Because on the cash balance side, we're typically going to invest that a little bit more conservatively. So let me give you an example. Let's say we're shooting for like a 70-30 split between stocks and bonds, kind of a middle of the road, I guess you could think of as a balanced portfolio. We might say, hey, you know what? Well, let's really load up and put like 100% of their 401k or their IRA in stock, because the cash balance plan, which is going to make up a sizable portion of their retirement, is going to be really designed to be more conservative, have some more bonds, and we're kind of targeting like maybe a 5 or 6% rate of return over the long term. Because with these cash balance plans, as an employer of the plan, you're responsible as the plan sponsor to make sure that your employees are going to have enough, and that you're ultimately in compliance with the law, that you have enough funding coming into that plan every year. Okay, let's pause and let's do another polling question.
All right, that is the third poll of the day I just launched. Let us know here, what is the common lifespan for a cash balance plan. You have 4 options to choose from. You guys know what to do. Oh, you guys are getting your votes in quick. I'm definitely seeing a clear leader here. Definitely thank you all for participating in these polls. Submitted questions in the questions panel. I'll go ahead and shut down this poll in 3, 2, and 1. Share these results out with you. You see that 41% answered 4 to 6 years, 26% say 10 to 12 years, 23% 15 years or more, and 11% 1 to 2. Back to you.
Awesome. Yeah, really that sweet spot. We see most plans is going to be 4 to 6 years, something like that. Of course, we might have some longer ones. Now, I'll tell you, you may have heard of old pension plans. I know of a number of companies that used to have a kind of a traditional pension plan, and then they evolved that into a cash balance plan as a long-term operations. This is typically for companies that have been around for a long time. Think utility companies or kind of big old manufacturing companies. But what the target audience I'm speaking to here is kind of that 20 employees or less zone. And typically for owners of those businesses, we're just keeping them open for a few years. Okay, so when you design a plan, again, you're looking at the 401k, the profit sharing, and the cash balance plan and seeing how they work together, if we should use one of them or 2 or 3, all in connection to achieve your goals. And let's take a minute and talk about vesting just briefly. With vesting, if it's just you and a spouse, then typically you want to just vest right away. But if you have employees with a lot of turnover in your business, it might make sense to extend that vesting out a little bit longer so they've got some skin in the game. Okay, drafting plan documents. Again, you'll work with your TPA and your actuary to come up with those. And typically, you're not drafting them from scratch. In fact, you're adopting a plan that has already gotten the stamp of approval from the Department of Labor and from the IRS. And that plan, you just kind of adopt it. It's literally a trust that you set up, and then you can begin funding. There are some contribution deadlines. The nice part about a cash balance plan is you've got some flexibility on when you fund it, kind of like profit sharing. And so it doesn't have to be in, by December 31st, let's say. You've got some time where you can make those contributions. And then termination compliance, again, we've got the same thing. You're going to work with your TPA and your actuary whenever that plan ends and you want to do the rollover, and then they'll make those filings for you. Okay, so if market performance exceeds the interest crediting rate, again, the interest crediting rate is whatever you come up with in your plan. We said before, hey, maybe let's use the 30-year U.S. Treasury, and that's going to target right around 5%, for example. And the market exceeds that, so the assets in that plan do really, really well. Then, as an employer, your contribution for the following year will typically be reduced because you've got to keep that plan assets in a certain range based on your employees. So there's some pros and some cons there. If you have some shortfall, so the market performed like it did last year, really stunk, then you potentially have the opportunity to increase those contributions. Again, with those contributions, whenever you make that as an employer, that's a deduction right on the tax return for the business. And if it's a flow-through entity, boom, comes straight to you. It's going to be an awesome opportunity for you there. Sometimes it makes sense to be strategic on how much we pick up with the shortfall, but certainly shortfalls can be spread across a couple of years. Okay, so how do we start investing inside a cash balance plan? Really, you want to identify your objectives, right? How many employees? What are the ages? What's the income? How many people are going to actually stay with this company for the long term? Again, it's kind of like looking into a crystal ball, so to speak, but typically with small business owners, you've got a pretty good idea of your employees and where they're headed, where the business is going. And that's going to really drive the investment decision. You want to determine the time horizon and then consider the tax strategy. Like I mentioned before, when you're designing a portfolio, typically we're going to put really kind of growth assets inside of a Roth or a tax-free account, because for most retirees, we take distributions in a specific order. Typically, we'll take it from a taxable account, like a brokerage account, for example. We have long-term capital gain treatment if you qualify for holding assets for a period of time. The second bucket we'll draw from, is going to be from a taxable retirement account, right, like a traditional IRA or cash balance plan. And then the third option is going to be tax-free assets, like a Roth, or one of my favorite retirement accounts, a health savings account. And bear with me for a moment. I just love health savings accounts. I think they're probably the most underutilized retirement planning vehicle in America. Now, of course, they're not for everyone. You've got to have the high deductible health insurance plan. You've got to qualify. And the IRS limits, so you can put in, somewhere between $7,500 and $8,000 as a family. But boy, the benefits of getting that contribution going into an HSA that are tax deductible, both at the federal and state level. And then if you invest inside the HSA, which if you didn't know, only about 4% of Americans with a health savings account invest their HSA. Most people just get the debit card out and swipe it. That's fine. The third benefit is if you use it for qualifying medical expenses way in the future in retirement, then it's a tax-free distribution. And if you didn't know, you can actually reimburse yourself for prior year medical expenses from your HSA. It's really awesome. I know a lot of your clients are probably focused when they're trying to itemize, or hey, I want to get some medical deductions. I had a lot of expenses. That 7.5% AGI floor can be an enormous hurdle to leap over with an HSA. None of that has to happen because you got the deduction at the beginning. Additionally, you get a fourth benefit, not only tax deduction coming in, tax deferred growth, and then tax-free distribution for qualifying medical expenses. But the fourth benefit is if you do it through payroll, oftentimes you can avoid FICA taxes, right? And for a small business owner, avoiding Social Security and Medicare tax, again, we're limited. It's just a couple of $1,000, but every dollar counts. It might be something for you to consider sharing with those that you work with or for yourself. Okay, I'm off my HSA rant, but one of my favorite retirement plans. So what are some funds that you can use inside of the plan? Of course, you got the money market fund, kind of around that 4 or 5% range. Bond funds, right now, if you didn't know, inflation and interest rate risk are probably the biggest risks to bonds. And a number of people are holding on to shorter duration bonds because they don't know what the Federal Reserve is going to do. And so that's just something we'll want to think through when designing a portfolio for that cash balance plan. Of course, you've got the stock or equity funds. There's some awesome, in the last decade or two, some awesome index ETFs. I'm a big fan of index funds. Again, this is just for education, right? But I'll tell you, when it comes to investing in publicly traded stocks, boy, it's hard to fight against the data. It's just overwhelming. A passive portfolio, at least that the publicly traded stocks have, really makes a lot of sense. And then you've got alternatives like private equity or private credit funds, where you can get some alternative exposure to different assets within your cash balance plan. Of course, with the cash balance plan, just like you would imagine a big pension plan for a big company, they're really going to want to be strategic because they are on the hook for, the employer is on the hook for planning and making sure the investments are adequate and designed to achieve the goals, both to stay within compliance for the plan and to ultimately give a big benefit to them and their employees. Okay, so let's go back to that illustration so you can kind of see that full picture once again. Again, this is for a couple. They paid themselves $160,000 roughly. They were able to sock away almost $250,000 into a cash balance plan in 1 year. Add on a little bit of profit sharing just to squeeze out an extra dollar or two. So we're looking at about $250,000. Then we added on the 401k plan. So then we've got the cash balance plan on the left, 401k plan coming in on the right-hand side there, and we're able to get right at that $300,000 amount. That's impressive when you think that $300,000 is a tax deduction for that person in that year. And if you're at a healthy 40% combined state and federal income tax rate, boy, we're talking about some serious money, right? Around $120,000 in tax savings. Now, again, let's not play the charade of thinking that saving is there forever. Of course, you're going to have to pay the tax in the future, but with a cash balance plan for someone in their 40s, 50s, and early 60s, where they can see retirement on the horizon, this can be awesome around timing the deductibility of the contribution in high income years, and then recognizing that income strategically and potentially with a Roth conversion. Okay, so my team and I will run a no-cost illustration for you or for your client if you think it makes sense, just to give you a ballpark idea of what a cash balance plan and 401k might look like for you. Here is my name and contact information, and I think, Jasmine, we're ready for the fourth polling question.
All right, you got it. That is the fourth and final poll of the day up on your screen now. If you missed the poll today for any reason, be sure to cast your vote here and now. This one is true or false. Let us know if you have a 401k plan already set up, then a cash balance plan is not for you.
Awesome. I hope you've been able to see while you're answering that question the really powerful tax planning opportunity that we have when we use a cash balance plan in connection with the goals of a small business owner. And boy, the opportunities have really come a long way, really in the last 15 to 20 years, when we've gotten a lot of green light from the Department of Labor and the IRS to fund these retirement accounts and really catch up on contributions for employees that have been kind of late to the game for their retirement planning.
All right, I share the results of that fourth poll on screen now, and I will give the last 9 minutes back to you, Isaac.
Awesome. Thanks, Jasmine. So happy to chat with you, answer any questions if you have, connect on LinkedIn. I also post some videos on TikTok, believe it or not. We'll see how long that stays open for. That's Finance on the Fly. If you're interested in learning more, most of my content is designed for small business owners and entrepreneurs. It's really the area where I focus on. And here's the disclosure for you. It's been great chatting with you today.
All right, thanks so much for presenting this topic with us. There are a couple more questions in here. I'll definitely be sure to share them with you after we close down. Did you want to tackle any other frequently asked questions or any final remarks before we close the webinar today?
Nope, I think it's been great. Thank you very much.
Yeah, absolutely. I definitely have to agree. And I'm checking out that questions panel right now. I'm seeing that our attendees feel the same, saying great presentation. Thank you so much for your time. And I really have to echo that gratitude. I appreciate you spending this time with us and really helping to minimize the confusion on a really complicated topic. And I'm seeing more questions continuing to filter in, as well as the thank yous. Of course, everyone who's attended today, be sure to submit your feedback in our course evaluation. That should be sent to you very shortly via email. So please take the time to fill that out and let us know how your experience was today. Of course, I can't end without thanking our attendees for being here, sharing this time with us, leaving great feedback and being so engaging, asking such great questions. We really appreciate you guys taking the time out of your busy day to learn with us. Now, just a quick reminder, CPE credit will be processed a little bit later today, and that, as well as the archive recording of this webinar, will be available in your CPA Academy account within about 24 to 48 hours. Again, we did record this webinar, so the archive will be in your account as well, the handouts, all that. I just wanted to remind you to also check our website for important information, helpful resources, and we are hoping to see you all on a future webinar. Thanks so much, everyone, and have a great day.